Hello everyone. Today we're going to be looking at Markowitz portfolio theory, also known as modern portfolio theory, and how to apply it in real-world examples. A lot of times we use these statistical measures in textbook applications. We learn it in college and then we dismiss it. But what if we can include this in an ordinary life situation? For me, I had 14 ticker symbols available either in index funds or mutual funds in my own personal 401k. When I first started working at my employer now, I just chose some basic review, looked at some Sharpe ratios, and looked at overall return and just picked a few. But I wanted to challenge myself to think, am I getting the best statistical return possible for the amount of risk that I'm taking? So this is what we're going to walk through today. The first step would be to go to Yahoo Finance. Punch in the ticker symbol for each one of these. Find a common start date. For example, in my case, each one of these funds dated all the way back to January of 2008. The more history, the better. Also, try to find funds that have gone through at least one economic cycle. A fund that's in its infancy, is only a few years old, is not going to provide meaningful data for someone that needs a strategy to build a portfolio long term, say over 5 or 10 years. Once we've gathered the data from Yahoo Finance, by going to historical values, finding the common start date for all of these, and filtering by daily returns. We can then take the daily returns and do a percent change, which is new minus old divided by old. Once we have all the daily percent changes, we put them in a common format seen here. Put them side by side in adjacent cells with the appropriate start date. A VLOOKUP function may help here. Also, one piece of advice, make sure to format your numbers. It's easy to get confused switching between decimal and percentage, so I like to leave everything as a percentage with 2 decimal points. The next step is to create a variance/covariance matrix. Look at the formula above using an MMULT formula, a transpose formula, and dividing by the number of samples. When using an MMULT function, it's important to know that you're going to have to enter it using a control, shift, and enter function as seen above here. Control, shift, and enter. Notice how the MMULT matrix refreshes. If you want to drag it across for all of these, there's no reason to do it individually. You just simply highlight them all. Again, control, shift, enter. The next step is to take the covariance values and multiply them by 250. Why 250? Well, that's because that's the average trading days in the Yahoo Finance data. We will also need to calculate the average returns. We can do this by taking the average of the columns to the left and annualizing them. We'll do this by multiplying by 250. That's the number of trading days. We also want to net out any fees that the funds are associated with to get a net cost. In order to do some calculations, let's reference those cells back to the Index Model tab as seen on the other page. In order to calculate variance, let's use a sum product function as seen below. Make sure to use absolute brackets on the reference for the weights row. Also, for each fund, let's add an average expected return as referenced from the Index Model tab net of fees. We're also going to add a return terms piece. This is simply the weight times the expected return. From here we can calculate variance, which is just the sum of the variance terms, standard deviation, which is the square root of variance, and the weighted average return, which is just the sum of return terms. We can also calculate a Sharpe ratio, which is the return divided by the standard deviation. Notice in this example, it has a 0.46 Sharpe, which isn't that good. But notice I've just thrown in an equal weighting of each fund, just for illustration purposes. We'll reference that in the graph below. The next step is to calibrate your solver model function. In this case, we want to set the objective, the Sharpe ratio, to be maximum. By changing variables and cells across the top, we also want to put some constraints in there. We want each weight to be greater than 0 but less than 100%. It wouldn't make any sense to have a negative number here or one that's greater than 100%. That would include short positions or on margin. We also want the total to be 100%. And then we also want to add, by intervals, let's say 3% all the way up to 20%. For example, if we wanted to change 13 to 14, we would highlight it, click change, change to 14, click enter, and then hit solve. Notice that we have a new value here that we can copy and paste in the table below. Once you've run all those permutations and you've pasted them below, we can create a chart. Notice that I have an expected return range of 3% all the way up to about 14%, which was the highest return for any individual stock. The portfolio on average can't be any higher than its greatest component. Notice that I have a few notes in here. One was the previous portfolio, which is what I just arbitrarily picked when I first started with my employer in this 401k, and then now what my revised portfolio is based on what my expected returns need to be. From here, let's make a chart. I have one below, but I'll show you the easiest way to create it. Click on your headers, drag them all the way down, insert, charts, scatter. There you go. In this case, it'd be really helpful to have data labels. We can do that by clicking the dots, going to Add Data Labels, click on the data labels, Format Data Labels, Value from Cells, then we can grab our notes right here. Click OK, remove the Y value, and now we can get clear illustration of the notes related to each relationship. Notice that the relationship of points create a curve. This is called your efficient frontier. These are the theoretical highest Sharpe ratios, or the highest risk versus return that we can create from the permutations available. Notice that I have two data points that don't fit a tangency within the efficient frontier. First one would be my first arbitrarily picked portfolio. While it has a high rate of return, it also has excess volatility measured by standard deviation. Also, if we were to just take a little chunk of each permutation available, or each option available, that the equal distribution would not provide ample returns for the amount of risk that it takes. In this case, I have a 10.12% return. There's a number of reasons for that return. One is a calculation based on the future earnings that I think I need to have in retirement, and also credit risk premiums above other asset classes such as gold and alternative assets. So in this case, we can use solver function to calculate the best Sharpe ratio with the permutations that are available to reach our returns. Let's click solver. Notice I have my 10.16% return here. Click enter. We go to the top, and then we can see what our weights are. It'll be a little over 56% on TRLGX, a little under 44% for MWTRX. Well, since my fund will only allow whole numbers, I've just moved this to 56 and 44. This provides a Sharpe ratio of 80, which is substantially better than the 53 that I had before. So in layman's terms, what did I just do? Most people aren't going to be upset if they get 10 or 11%. They're not going to miss the 1% difference. What they are going to be upset about is volatility in rough markets. So if I have gone from an 11.43 expected return to 10.2, but also reduced my standard deviations from 21.58 to 12.66, what I've essentially done is taken an 11% discount while also reducing my risk by 41%. I'll consider that a good trade-off. I've also reduced my overall exposure to the equity market, which is substantially more volatile than bond market, from about 90-95% down to about 56%. So ironically enough, out of the 14 options available, I'm only going to use two funds. One is a large cap growth, which is an equity fund, and one is a bond fund. It's very close to the old 60-40 portfolio. I hope you found this information useful. Maybe try building one for your own retirement portfolio and let me know your results. Please like and subscribe, and make sure to turn on notifications